Welcome back to Investing Talk podcast.
Today we're looking at Marvell technology.
As usual, before we start, subscribe, like, and comment to this video to support the show.
Because today we are digging into something that is, well, it's absolutely critical to the AI boom, but nobody really talks about it.
Right. Everybody is so hyper-focused on the shiny engines, the massive language models, the flashy compute processors making all the headlines.
Exactly. The processors get all the glory.
Yeah.
But if you think of those high-powered AI chips as the brain of a data center, Marvell technology is the nervous system.
The nervous system.
Yeah, and think about it. A brain, no matter how powerful it is, it's completely useless if it can't send signals to the rest of the body instantly.
It sits there.
Right. The data literally gets stuck. Marvell builds the critical infrastructure that connects all these massive clusters of servers so they can actually talk to each other.
Without that high-speed connectivity, the whole AI revolution basically hits a massive bottleneck.
It hits a brick wall. We're talking custom silicon, physical infrastructure, Ethernet switches.
So for you listening, while the rest of the market is, crowded into the same 2 or 3 processor trades, understanding this nervous system might actually be where the real compounding value is hiding.
I completely agree. The scale at which they're operating alongside the biggest hyperscalers is just phenomenal.
It's staggering, really, but before we get swept up in that whole narrative, we need to stress test the actual data. Let's start with the fundamentals.
Okay, well, the recent financial performance is a blaring siren for their market position. Looking at their Q4 fiscal 2026 revenue, they posted a record $2.219 billion for the quarter.
Wow.
Yeah, that's a 7% sequential increase from the previous quarter and a massive 22% year-over-year jump.
Driven almost entirely by the data center buildouts, right?
Oh, absolutely. The demand there is just insatiable.
The quarterly snapshot is great, but pulling back to the full year gives you a much better sense of the trajectory. Like, are they actually sustaining this?
They definitely are.
Because full-year revenue for fiscal 2026 was roughly $8.2 billion. That's a 42% year-over-year growth rate.
And what's really interesting about that number...
Right, the restructuring.
Yes. If you back out their automotive Ethernet business, which they smartly divested to focus just on core connectivity, that year-over-year growth rate jumps to 45%.
Trimming the fat to feed the engine.
Exactly. And that engine is the data center segment. It's the absolute powerhouse, making up about 73% of their total quarterly revenue.
73%.
Yeah, nearly 3/4 of their revenue is directly plugged into the fastest growing capital expenditure trend in global tech. They are completely tethered to this AI infrastructure expansion.
Which is great for top-line growth, but Wall Street is notoriously unforgiving right now when it comes to profitability in the semiconductor space.
I want margins.
Right. But looking at the bottom line, Marvell had a clear Q4 earnings beat, adjusted EPS of 80 cents per share, beating analyst estimates by 1.37%.
And beating revenue expectations by 0.86%.
Which is incredibly hard to do right now, given how high the market has set the bar. And management even raised their Q1 guidance based on that data center demand.
Telling you, this isn't just a blip. It's a forceful trend heading straight into fiscal 2027.
So how does that translate to their overall financial health?
Well, you look at their cash position and margin profile. In Q3, they posted gross margins of 51.6% GAAP and 59.7% non-GAAP.
Near 60% margins for a hardware business.
It's wild. That profile looks more like a software-as-a-service company than a traditional semiconductor manufacturer.
And that generates massive free cash flow, which, in this industry, if you aren't pouring cash back into R&D, you're dead in the water.
You're obsolete before the year's over. This cash flow lets them aggressively reinvest in custom silicon, and that fuels their competitive moat.
Let's talk about that moat, because it's heavily reliant on their entrenched intellectual property.
Right. Their IP and high-speed connectivity is unmatched. Ethernet switches, computing engines, and SerDes.
SerDes, which handles serializing and deserializing data.
Exactly. It's the specialized tech that lets oceans of data travel across a wire at light speed without getting scrambled. But there's a highly specific detail in their engineering that really gives them an edge.
The voltage regulators.
Yes. As hyperscalers build these colossal server racks, the electricity draw is just terrifying. Heat and power loss are the ultimate enemies of compute.
So how big is their advantage here?
Marvell's voltage regulators actually reduce transmission losses by up to 85% for power platforms operating over 4 kilowatts.
85%.
Imagine scaling an 85% reduction in power loss across an entire Amazon or Microsoft data center. The energy savings and the performance bumps are astronomical.
It's an engineering advantage that competitors just can't easily replicate, and that leads to brutal switching costs.
Huge switching cost.
If Amazon or Microsoft builds a multi-billion-dollar architecture around this specific nervous system, they can't just rip it out a year later to save a few pennies on a competitor's hardware.
They are completely locked in. And Marvell has secured massive multi-year design wins with both of those hyperscalers.
Winning the initial design essentially locks in the revenue for the whole life cycle of that hardware.
But their strategy goes way beyond just dominating current copper wiring. Which brings us to a massive forward-looking catalyst, their acquisition of Celestial AI.
Ah, the optical interconnects.
Right. As data centers scale up, pushing electronic signals over traditional copper hits hard physical limits. Copper gets too hot. The signal degrades over long distances.
So Celestial AI fixes this.
By using light, photons, instead of electrons to connect multiple racks of servers, it allows for massive multi-rack scaling without the thermal nightmare.
And projections show this optical tech could add an annualized $1 billion in new revenue by fiscal 2029.
Maximizing the current cycle while acquiring the exact tech needed for the next generation of data movement.
The fundamental narrative is remarkably strong. Pivoting to the charts.
The price action is definitely reflecting all those fundamentals we just unpacked. After that Q4 earnings beat and the raised guidance, the stock saw a massive after-hours surge.
Breakout momentum.
Serious breakout momentum right now.
But we should put that into context for you, especially with the recent volatility. Because earlier, in early 2026, the stock took a pretty sharp 23% year-to-date dip.
Whole sector took a hit.
Right, a harsh pullback as the market tested the AI trade's sustainability. But the recovery here has been remarkably aggressive.
It's rallying right alongside the major peers like Broadcom and NVIDIA. It has the relative strength to bounce back.
And the institutional flow validates that.
It completely validates it. The technical setup heavily favors the bulls right now. We're seeing increased buying flow and volatility that points to a very strong potential for higher highs.
The market is digesting those record design wins.
Exactly. Buying pressure is consistently stepping up, breaking psychological resistance levels. That recovery from the 23% dip wasn't just retail traders catching a falling knife.
It was a structural reallocation of capital, shifting to sentiment and market perception.
There is a really fascinating contradiction here that you need to be aware of.
Yeah, if you look at the quantitative ticker sentiment scores, those purely algorithmic scans based on historical trading patterns, it's showing a flat 0.
Totally neutral.
The algorithms are shrugging. But when you look at the actual mood, the latest market context, the top 5 news stories, it is undeniably bullish.
The headlines are all earnings beats, revenue records, AI boosts, raised guidance.
The lagging quantitative score is just completely out of step with the tape.
And Wall Street analysts are definitely not waiting for the algorithms to catch up. They are projecting massive upside for 2026.
Taking those Q4 actuals and extrapolating them straight into the fiscal 2027 expansion.
Because the consensus view is that these infrastructure tailwinds are a multi-year supercycle, not just a fleeting trend.
And institutional money is backing that up. The recent 13F trends show glaring institutional accumulation in semiconductor plays.
We're seeing implied cluster buying directly tied to those Amazon and Microsoft design wins.
The largest funds know that if those giants are spending billions on CapEx, a huge chunk of that flows directly onto Marvell's balance sheet.
It's the ultimate picks and shovels play. And they are hoarding the shovels. But there's also this speculative excitement in the industry right now.
The Golden Cable Initiative.
Yes. The rumors around the 1.6T advanced Ethernet cables.
Moving data at 1.6 terabits per second.
You need next-generation interconnects for that.
Yep.
If the industry rumors about these AECs hold true, it adds incredible hype to their optical portfolio, aligning perfectly with Celestial AI.
That's the exact kind of speculative catalyst that drives FOMO for both retail and institutional investors.
It moves the needle long before the revenue is officially quantified.
Okay, so the fundamentals, charts, sentiment, it's all incredibly rosy. Record revenues, massive margins, unbreakable design wins. But our job is to find the cracks in the foundation. Now let's play devil's advocate and examine the bear case.
No company operates in a vacuum. The structural risks here are real.
The glaring vulnerability is customer concentration risk. We said data centers make up 73% of total revenue, but who is writing those checks?
That's where it gets precarious.
Fiscal 2025 data shows their top 10 customers accounted for a massive 81% of their total revenue. And even worse, just 2 of those customers each exceeded 10% of total revenue.
That is a fragile ecosystem.
If Amazon or Microsoft just decides, hey, we're going to optimize our existing infrastructure this year instead of aggressively building new data centers, the impact is immediate.
It wouldn't just be a slight dip.
It would trigger wild volatility. You are entirely dependent on the continuous spending appetite of a handful of behemoths.
The concentration risk is undeniably valid. Any macroeconomic headwind that makes them tighten their belts hits Marvell exponentially harder.
And the competitive landscape is brutal.
Very brutal. They are facing fierce, relentless competition from Broadcom in the custom chip space.
Broadcom is a titan.
Absolute titan, massive resources, aggressively fighting for market share in those exact same hyperscale data centers. The battle for the next generation of design wins is going to be incredibly expensive.
We also have to outline the macro uncertainties, specifically U.S. export restrictions.
Right, hovering over the entire sector.
The regulatory environment around what specific silicon, what processing speeds, what IP can be exported to certain regions is constantly shifting.
It introduces arbitrary boundaries.
Boundaries that can erase significant portions of a total addressable market overnight. It's a geopolitical variable nobody can control.
It definitely introduces friction. But you have to evaluate how the market digests those risks. Much of that geopolitical fear was actually aggressively priced into the stock during that 23% dip in early 2026.
The market reassessed the multiples, and it still recovered.
Exactly. And while the concentration risk is stark, their design wins are highly diverse across the hyperscalers they do serve. They're embedded in switches, security, storage controllers.
And with data center revenue forecasted to grow over 25% year over year into fiscal 2027, the sheer velocity of the expansion provides a massive buffer.
It shields against immediate downside risk, assuming the hyperscalers keep spending, bringing it all together for the final verdict.
Based on all the fundamental growth, technical breakouts, sentiment, and the structural risks we've unpacked today, we're revealing an official bullish score of 9 out of 10.
A 9 out of 10. That's a high conviction rating rooted in a highly specific multi-year thesis. Marvell is an essential enabler of this infrastructure build-out.
You physically cannot execute the AI revolution without their high-speed connectivity.
Between the $8.2 billion fiscal 2026 revenue, dominance in the data center, and the celestial AI upside, the play here is a multi-year hold into the fiscal 2027 expansion.
For you as an investor, it's about compounding gains alongside the premier infrastructure provider as these server racks scale globally. But before we wrap up, I want to leave you with one final provocative thought.
Okay.
As these massive data centers get exponentially hotter, denser, and infinitely more power-hungry, we are rapidly approaching the absolute physical limits of traditional copper wire. Will the optical interconnects we discuss, literally using light instead of electricity, become not just a competitive advantage, but the only viable path forward for the entire technology industry?
When the physical limits of copper force the industry to adopt light as the standard, the entire architecture of the internet changes overnight.
Thank you so much for joining us for this analysis. As usual, before we sign off, subscribe, like, and comment to this video to support the show.
We will see you next time.